Okay, I apologize for my little bit of a late arrival, and I'll apologize in advance for probably what would be a little bit of an early departure, or though you may not complain, I suppose. Start with attendance. Bowen. It's going to be a rough attendance day. I can feel it. Chisholm. Christian. Contreras. Curl. Eater. Ham. Hand. Lee. Linders. McClure. Navarro. Quintero. Ramos. Rodriguez. Carissa. Rodriguez. Giovanni, both here. Silvestre. Not here. Simpson, not here. Torque, here. Van Henkel. Walker. And Wilson. Awesome. Over half. We have a quorum. So based on the discussions we had on Wednesday, I wanted to throw this slide back up to talk a little bit about the relationship of interest rates and the economy, because we spent a little bit of time talking economic policy, political policy, monetary policy, fiscal policy, and what happens to interest rates under various scenarios and kind of what's about to happen or what do we think might be happening in reflection to interest rate environment today. And so there's a couple things that I want to be able to pull up, but the first thing was looking at the history. And again, you can tend to see that over time, two things have occurred. One is long-term interest rates have fallen pretty steadily since 1990. Now, 1991, this was the Bush recession. So there was a recession in 1980, 1981, 79, 80, 81, which we came out of in 82, 83, and saw a relatively robust expansion through the bulk of the 80s. There was a economic contraction or recession in late 1990 into 1991, which really had a significant impact on the 1992 election. So for those of you who might remember the 1992 election, there was this Bill Clinton versus George Bush the First. And there was this big comment of it's all about the economy, stupid. And so Bill Clinton ran on the economy and George Bush ran on the Gulf War victory in 1991. And what ended up happening, of course, was Bill Clinton won and you saw the economy begin to recover. We had one of the largest post-war expansions in history, started really before Clinton was elected, but we don't tend to feel the impacts of either an economic downturn or an economic recovery until a couple quarters after it's actually happening. It still feels painful as you come out of the bottom and start going up. And so what ended up happening here in 1992 is we saw one of the largest post-war expansions in history all the way through the Clinton administration. Then you saw a second recession. During that recession, in each one of these recessions, you saw interest rates come down in the short run to stimulate the economy. When the economy was cranking along, the interest rates would rise again. It would be a combination of two factors. One would be the Federal Reserve would raise rates to try and keep inflation down around 3% or so. The second was supply and demand for money was such that rates would naturally begin to rise as there was demand for short-term or intermediate-term borrowing. And you saw that long-term interest rates tended to be relatively flat through that cycle. We saw a recession again in 2001, and that was driven by technology. So back here was the advent of the internet. The internet was invented by DARPA back in the 80s, 70s, as a redundant way to communicate in the event of a nuclear strike. And so DARPA is a Defense Advanced Research something. I'm trying to remember, but it's essentially the Department of Defense invented the internet, multinodal communications, computer communications, in the event that the communication system was hit by a nuclear strike, which when I was growing up was our biggest fear, was that the Soviets would kind of nuke us all into oblivion. And so they invented the internet essentially to allow for multimodal or multinodal communications in the event that the primary communication system, telephone, went down. The internet became commercialized in the early 90s. So when I was in college, I graduated in 1993, we did not have email, we did not have internet, we really didn't have computers per se. We had to go to computer labs to use personal computers. They were still pretty expensive. The internet started ramping up in the mid-late 90s, and you saw the advent of cool things like Pets.com and other internet-driven companies here in the late 1990s. Combination of those weren't economically feasible, coupled with a general run-up in asset prices around the internet, caused a stock market crash and corresponding recession around 2000, which was, again, another election year. And so you saw the 2000 election year and Bush versus Gore. Bush won by a modicum of 573 votes in Florida, and then you saw a recession hit shortly thereafter. Short-term interest rates fall to stimulate the economy again, driven by monetary policy and fiscal policy. Long-term interest rates fall and then remain steady through to the next recession. We saw a relatively short recovery between 2001 and 2007, and then we saw a second fall. And the second fall, which was one of the deepest, which was the deepest recession since the Great Depression, occurred in all of your lifetimes in 2007, 2008, and into 2009, almost into 2009, where the economy, driven by hyperinflation around certain asset prices, predominantly real estate, and underlying bonds and consumer debt, that failed. Essentially, you saw asset prices collapse, and as a result, interest rates were dropped again to try and stimulate the economy. Once again, you had around 2008, there was another presidential election, and you saw a change from the Bush administration to the Obama administration, and then you've since seen one of the longest recoveries, although one of the mildest recoveries in U.S. economic history, from 2009, essentially late 2009, through until the present day. We haven't seen a recession in nearly 10 years, which is one of the longest periods ever. Having said that, there's a couple things that I will kind of bring forth. You'll notice that recessions tend to occur when? Around presidential elections. Does anybody know why? Anybody want to posit some theories as to why recessions tend to occur right around presidential election time? That's actually a very solid theory. There's two things to kind of keep in mind, and I'm saying this because we have, when's the next presidential election? 2020, November 2020. So we've got a couple things at play. Historically, you tend to see recessions right around presidential election years. It's driven by two things. One, you have in many cases concern around change. So the economy tends to slow as people go, okay, I'm not quite sure who the new president's going to be, and what their fiscal policy is going to be, and what their their spending priorities are going to be and those kind of things. So I'm just going to slow down and wait. I'm going to kind of hold off doing anything big until we kind of know who the new president's going to be. So you see this slow down, pull back, which tends to cause the economy to slow down as well. That's one. The second is you also tend to see a change in monetary and fiscal policy, which you're seeing right now with the current president, where he said, okay, I'm going to stimulate the economy. Mind you, the economy is already thoroughly stimulated, but he's like, I'm going to stimulate the economy. We're going to drive infrastructure spending. We're going to cut taxes. We're going to put America back to work again, even though unemployment is at its lowest level ever. So what ends up happening is you see a change after an election in fiscal and monetary policy reflected by the new administration, if there is a new administration. If there isn't, like during the Obama administration where there was no change, you saw no recession. During the Clinton administration where there was no change, you saw right around the 1996 election, things kind of slowed down a little bit. But once you got through 1996, there was no recession. You tend to see a recession when you see a change. So what we're looking at right now is, in my mind, a relatively high probability of some type of correction because we've got an overstimulated economy that's being overstimulated more around the 2020 election year. So we're probably 2 to 3 years out from what I would expect to see as a change in economic cycle. That actually will have given us an extraordinarily long post-war expansion. Having said that, you're starting to see already hints of inflation. Inflation was higher than expected. So if you were watching the news, inflation was higher than expected by about 0.1% in the last quarterly report, and it's likely to continue. And inflation is driven by what? Demand. So as demand continues to rise and supply can't keep up, prices begin to rise. And you see wage inflation, and you see capital goods inflation, and you see raw materials inflation. So you're seeing inflation kind of across the spectrum of inputs into production. And so you can expect that with inflation rising, demand rises. If demand, or it's because by demand rising, if we can't keep supply up or prices get too far ahead of the broad economy, you're going to begin to see a slowdown. And that slowdown is likely to occur. I think that there's a general consensus right now that there is a strong probability of a change in administration in 2020. And almost every time you see a change in administration, you tend to see an economic slowdown as well. So those are things that just kind of, as you look at history and you can start peeling some of this stuff out, those are things to be looking at. How many of you are graduating in 2019? Hopefully. 2020? Be ready. Those are all things to be thinking about. Be prepared. Be prepared. My prediction would be prepared for a tough job market for your 2020 graduates. If you're graduating this spring, you're in pretty good shape. If you're graduating next spring, 2019, you're probably okay. 2020 could be you can start seeing some teetering. 2021 is probably going to be a pretty rough year. Any questions or comments on this nifty interest rate? Okay, let me get us caught back up to where we talked a little bit about this last class, but I'm getting to the wrap up of the interest rate piece. As you can probably gather, interest rates are so critical to finance because the discount rate, the rate of return, or the required rate of return, the discount rate, the interest rate, the rate that you utilize for future value. So all of those components are all essentially driven by interest rates. So it's important that we understand the principles and theories behind the setting of interest rates because we use them in finance in every calculation, or nearly every calculation. There's a couple truisms or near truisms here on the board, and I want you guys to unpack them for me a little bit. The first one is the higher the rate of interest, the lower a firm's profits. Why do you think that's the case? didn't we say, you know, the higher the rate of interest, that means the economy is going to get superheated and interest rates start rising. So why do firms' profits start going down as interest rates go up?
Because when interest rates go up, not as many people, I'm guessing, would want to buy them.
So you start to see a slowdown in demand because consumers aren't going to be able to borrow to buy. What else? Yes, ma'am.
As interest rates go up, the price of whatever it is goes down. The value isn't that true? But
The value, if it's a financial asset, as interest rates rise, the value of the financial asset will fall. But what's that? So that's, we're not there yet. You're like 2 steps ahead. But the firm's profits. So this is the firm's profits. It's bottom line. Why would that get impacted by interest rates being up? We heard, you know, consumers or businesses aren't going to be able to borrow as much because interest rates are rising. So that's going to slow down demand. And that's true. That's a strong reason. There's a second reason. Yeah, you have to pay more. The business, a lot of businesses, they borrow money short term, or they borrow money on variable interest rate loans or variable interest rate bonds. So St. Martin's, for instance, our bonds are variable rate bonds. As LIBOR, the London Interbank overnight rate, changes and goes up, our bond interest rate goes up, which means we make less money because we have to pay more in interest. And so as a result, you've got these two elements. You've got a demand argument, which is as interest rates rise, it begins to slow demand because people will borrow less because they can't afford to borrow more. And therefore it slows down demand, which then slows down sales, which then slows down firms' profits. The second is that the cost to borrow for that firm to buy things, whether that's labor or whether that's raw materials, whether that's inventory, or whether that's financing accounts receivable, begins to rise. And so as a result, their interest costs go up. And so you've got increasing expense, decreased sales. Increasing interest rates are not really a good thing for business. Yes, sir.
So for the example you're going on, that's if they choose to borrow as opposed to using cash on hand.
That's correct. Although we're going to, as we get into capital theory and capital structuring, you're going to find that most businesses, optimally will borrow something in order to maximize return to the shareholder.
When
Will optimally borrow something. Yes, if it gets too expensive, if the cost to borrow gets too expensive, then there's a trade-off to equity. If the cost to borrow is really low, there's a trade-off to debt. Because again, you're trying to optimize the value to the common shareholder, or you're trying to optimize shareholder value in theory. How about this second one? Interest rates affect the level of economic activity, and economic activity affects corporate profits. How do interest rates affect economic activity? So Krista, it kind of started hitting on some of that because she got a step deeper. How do interest rates impact economic activity? What happens to the price of stocks and bonds if interest rates rise? They drop. So if you're a company that is looking to go public or looking to issue stock on a secondary offering or looking to issue bonds, are you more or less likely to issue those bonds or sell that stock into the open market when interest rates are rising? You're less likely, which gives you less capital to be able to invest in your business. On the other side, it impacts demand. So again, when we talk at the firm level, you see this, folks are less likely to borrow. And the firm is less able to borrow more. At the macroeconomy level, that is impacting aggregate demand and aggregate supply. And so economic activity begins to slow down as interest rates rise. If you think about interest rates and economic activity, the two of them kind of are used to balance each other. As interest rates fall, economic activity should rise. As interest rates rise, economic activity should fall. As interest rates rise, you tend to see, or as economic activity rises, you tend to see inflation come up. As economic activity falls, you tend to see inflation go down. And so the federal government and the Federal Reserve act with all three of those components to try and keep the economy growing at a pretty steady rate of 2 to 3% a year, keep inflation at about 2 to 3% a year, and try and perpetuate that cycle as long as they can. That's an optimal situation. We've kind of, over the last 75 to 80 years of active monetary policy following the Great Depression, most of the both Western Europe and the US have looked at that model and said 2 to 3% growth a year, 2 to 3% inflation a year, and a relatively steady, if anything starts getting too hot, you slow it down. You try and use a combination of fiscal policy, monetary policy, and kind of hold those two things in stasis. That's healthy. Once any of those gets out of whack, you end up pushing on the other to try and force it back down into equilibrium at about 2 to 3% growth. The other thing that you need, by the way, for 2 to 3% growth is either 2 to 3% population growth or a combination of population growth and efficiency growth in production. Otherwise, you can't continue to grow. So some countries, Western Europe, are experiencing declines in population. It's very difficult for their economies to continue to grow when your population is declining because you need inputs, and inputs include labor inputs. And so there's the argument for certain types of immigration policy is that you need to have your population continue to grow in order for your economy to continue to grow. And if you don't have net growth in your population, you probably need to lighten or incentivize immigration to be able to allow your population to grow at that 2 to 3% range. And if you're not, you need to make some changes in your policy to allow for that. The last thing that we'll cover is one of my favorite of all time equations, which is cash flow over rate of return is your determinant of value. And we talk about this kind of in multiple ways, but in every class, the value of any given financial asset is what? It's a function of two things. The value of any financial asset is a function of two things. What are those two things?
The expected return of expected value of perceived for future value of the asset discounted by the interest rate.
Right. The value of any given financial asset is a product of the sum of the expected future cash flows discounted at an interest rate, where that interest rate reflects the risk associated with the expected future cash flows. Again, if you remember nothing out of this class in 20 years, remember that the value of any financial asset is a factor of the expected future cash flows discounted at a rate of return, and that rate of return comprises the interest rate. For that rate of return, which in this particular case is an interest rate, is a rate, comprises a measure of the risk. Any questions on this interest rate concept at all? Okay, we're gonna do one more thing, then you're gonna get an early Friday. So if you hold off a sec before you escape. Today was a good day to both be in class because I took attendance, and to be in class because you'll probably be done 15 minutes early. So you can let all the 10 people that weren't here know that they missed the wrong class. Okay, what I'm going to show you right now is available on treasury.gov. You can see that this is the current term structure of interest rates. It's essentially the plot of the existing yield curve for interest rates. This is for US Treasuries. And so what's happening to interest? So this is the 15th, this is today. This is February 1st. What's happened to interest rates over the course of this month? Just give me some basic information as to what you, in just looking at the yield curve, what's happening to the yield curve as you look at this graph. Short term's going down. The long term rates are going up.
Well, 2 is inverted. It goes from 216 down to 210 and then back up to 210.
So what you saw, so what you're seeing here is that this dropped, and now it's started to rise. Do you see any points of inversion kind of in a quick look? Inversion would be, remember, short-term interest rates, lower rate, long-term interest rates, higher rate. That would be a normal yield curve. An inversion would be a point at which somewhere in here, a short-term rate had a higher interest rate than a longer term. Do you see any points of inversion currently in the yield curve? There are none. So there's right now the yield curve is a normal shaped yield curve. The market is saying, okay, we're not expecting anything really wacky in theory for the next 6 to 12 months. However, you pointed out, short-term rates are beginning to fall. Long-term rates are beginning to rise. Matter of fact, short-term 1 month is beginning to fall. As you start moving out the 3-month, 6-month, 1 year, 2 year, 5 year, 10 year, 30 year, those are beginning to rise. What is that an indicator of? What is the market pricing into these bonds? Inflation. Why is it not pricing it into the short term? Not much inflation this month. That's a perfect answer. What you're seeing here is just in the last 2 weeks, interest rates at the long end have gone up by 15 to 20 basis points. The market is beginning to price in inflation, an expectation of inflation, and that's a relatively aggressive change in just 2 weeks. You're starting to see a relatively healthy increase in expected inflation rates of between 15 and 20 basis points, which is 0.1 and 0.2%. In the long end of the curve, and you're actually seeing some similar rates starting to hit about half that at the 3-year, 4-year, 5-year point. So what the market is saying is they're looking at all this fiscal policy, monetary policy, all the happy stuff that we sat in here and have been going, okay, well, what's the impacts? What aren't the impacts? You can look up on treasury.gov and pull up what the yield curve looks like, plot it, and begin to see what the market consensus is for inflation. Begin to see that, hey, the market is saying inflation is coming. We're starting to see that in the interest rate curve. This website, you can actually look at things like 2015. I'm not going to look at the whole year of 2015, but for comparison, take a look at what's happened to interest rates since 2015, just in the last 3 years. 1 month rate, 30-year rate, 30-year rate 2.5, 2.6. 1 month rate, 0.02%. If you look at the current rate, 3 years later, across the board, it's up by almost 100 basis points. What's that telling you? What's happened in the last 2 or 3 years?
The economy is
The economy's improved, unemployment's gone down, and what's the expectation for the future?
That inflation is gonna rise.
That inflation is going to rise. Looking even 1 year ago. Actually, let's go to just before the election. November 2016, the election. How much impact do you think the current president's monetary and fiscal policy have had on the market for interest rates? Do you think they've had any impact at all?
Would it have been his policies or just how things play out in the market?
Combination. It's a combination because the market is a reflection of expectations in the future, right? When we think about financial markets are really looking forward. Finance is a forward-looking science, and so the market is really going, okay, I've got a financial asset or I've got an interest rate, and that's a reflection of my expectation of the future. Again, in interest rate case, it's based upon inflation and maturity risk premium, liquidity risk premium, and default risk premium. And in the case of a financial asset, it's a combination of expected future cash flows and the discount rate. And you can see that right after the election, interest rates rose a little bit, but not dramatically. A year ago, (2017), you can see they were up a little bit more, and then they've continued to rise. And that's being driven by policy plus economic expectations. Any questions on where to find this stuff? Because again, I know I find it probably more fascinating than most folks in the room, but it is easy to get to. It's easy to analyze, and it's easy to plot, and you can begin to see inversions and such things. You can also export it. You can see if there's an export to XML, and you can drop it into an Excel spreadsheet, plot the graphs, and get all excited about it. Any questions on this stuff? All right, remember, quizzes are due. I will see you all on Monday. Next week is another, or I won't see you on Monday. I will see you on Wednesday. Next week is a relatively full week. We're going to be starting into bonds and bond pricing and bond characteristics. So we're going to start into kind of the real meat and potatoes of financial instruments. If you have any questions or need to make any appointments, come see me. Otherwise, have a great weekend.